I don't have enough cash flows, but I'm somehow still running my businesses via my subsidiaries and still going ahead somehow. I mean, is that possible? So, this is going to be specifically about Viceroy's report about Vedanta and what exactly has been claimed. I am specifically going to cover about the debt servicing part and all that. So, we see the interest and the finance charges in two places. Basically, the finance costs which are added back, which is under the indirect method that is usually followed for the cash flow statement. So, indirect method, we add back all the non-cash items and all the expenses out there in the P&L to the PBT, profit before tax, so that we can arrive at a figure like EBITDA, earnings before interest, tax, depreciation, amortization and all, to make sure that we only include cash flows, basically, the actual net impact on the cash flows. So that is included, that is all calculated. Then we calculate the changes in inventories, receivables, payables, all of the working capital out there, and provisions and all of that, and we record that, and we find out the cash flow from operating after that. And we also, following that, we subtract the tax paid along with refunds and interest paid and all that. So in that section we can see the difference between the two. So it is around 4.7 billion is the amount before the interest is subtracted. This is the actual interest paid during the year in the form of cash as per the loan agreements. So that's 4.7 billion the cash flow from operating before the interest is paid, and after the interest is paid it comes down to around 2 billion. So clearly it shows that there has been a significant amount of debt which is significantly affecting the cash, and it's a consolidated financial statement, so basically all the subsidiaries out there are included. My point is not about questioning about this specific thing, it's just about how much free cash flow is left after you subtract your capital expenditure and from your operating cash flows. That is actually very less after this interest is subtracted. They have got lots of debt out there, and they are potentially not even recording some of the debt, like this is not even shown properly. They also claim that the cost of debt given in the consolidated financials are 15%, but it is in reality, according to their disclosed notes, only around 9 to 11% based on their disclosed notes and based on whatever bonds they issued to the public and all. So it's all a question mark, basically. Nobody can say who is right, who is wrong, but these are some facts that we should know, and these are some ways of understanding the cash flow statement better. Through such scenarios we can understand how to utilize our analysis, our financial knowledge, to understand financials of such case studies a bit more properly. And this is a very good way of learning, guys. So if you found this useful, please do like and share, and do comment down below for any of the thoughts related to this. Okay, bye.